Well, joining us now is Tim Evans from Longleaf Trading Group. He speaks to us now live from the CME in Chicago. Tim, hello to you. All eyes really on that OPEC meeting, and we're seeing incredibly volatile performance from oil prices. To say that the outlook is shaky for production moves from that OPEC meeting seems to be a bit of an understatement.
Yeah, no doubt about it. Nice to be with you, Natalie. To quote the great American philosopher Yogi Berra, this feels like deja vu all over again. I mean, we were just here in late September at the Algiers meeting when they were coming up with this preliminary agreement. You know, and all the same issues that those members were facing then, we're facing now. 2 months later, just a few days out from this very important meeting. The market has no idea which way this is going to go, and the volatility levels that we're seeing in the market clearly are reflecting that.
So let's take a look at some of the individual players then and how they're contributing to this overall picture. And it really seems that it's Saudi Arabia kind of playing hardball in terms of its terms to an agreement.
Yeah, I mean, at the end of the day, I mean, they put out 10.5 billion or million barrels a day. So that's roughly about a third of total output. So, I mean, they're holding a strong card in terms of the way this negotiation is going to go. They've pretty much set terms to, the deal that they would like to see. But, at the end of the day, the other members aren't, really on board with some of the particulars of that deal. But, again, as the key producer of OPEC, I mean, they're able to push the envelope a little more than the other members, and they're certainly doing so.
Tim, to your mind, what would be the ideal scenario to come out of the November 30 meeting?
Depends, what the outcome that you're looking for. I mean, if you're looking for, higher energy prices, clearly the desired, well, if that is the desired outcome, clearly the way that would need to go is they would need to come up with a production cut at about 1.3 million barrels, roughly, and have enforceable measures that the market would have confidence that they would be followed through on. My personal view is that's probably not going to be the outcome. It'll probably be somewhere in the middle, but, if you're looking for an ideal scenario, that definitely would be it.
Tim, in terms of what happens next, then we've had analysts, including Morgan Stanley and also Macquarie, saying oil prices will correct sharply if OPEC fails to reach a deal, potentially going low as $35 per barrel. Is it fair to make assumptions like that, or are markets really in wait-and-see mode?
I mean, that's certainly possible. I mean, especially at the levels that are of production that we're currently seeing. But we also have, a number of oil fields that have come online in just the last couple of weeks. So, clearly these members have the ability to produce more, and they most likely will if no agreement is met, which would obviously put further downward pressure on crude prices. But just to kind of put it in perspective, I mean, all we really have to do is see the ranges that the market's trading or has traded over the last couple of months while the market's kind of handicapping the likelihood of this deal going through or not. We were a little north of 52 and downward of 40. If it's fully discounted that no production cut will happen, then clearly breaking through that $40 level is a reality we'll most likely end up seeing.
We've had comments coming through from Russian President Putin, also Rouhani from their meeting, stressing the importance of OPEC's effort to cut output. Saudi Arabia has not attended that meeting with Russia and Iraq. Again, these comments coming through Putin, are they really telling of any sort of sentiment?
Well, I think really what we're seeing is the strong negotiating tactics of Saudi Arabia. Clearly they're very experienced at this. Clearly, again, they're holding the dominant card in the negotiation, and they're playing their cards. I mean, while Saudi Arabia still has a lot to lose with energy prices collapsing, I think some of the other members are in a worse position if that was to occur. And I think Saudi Arabia knows that, and I think the other members know that as well. So, they're in a position to play hardball. They're not going to attend certain meetings. They're going to resist counter offers from various other members. And that's the way they're playing this. And in my personal view, it's probably a smart play.
So from an investment stance then, how are US miners and energy players really positioned against some of this pricing volatility that we have seen?
Well, when we saw the market rally to a little north of 52, I read a lot regarding energy producers being able to use those elevated prices to lock in some hedges. So, that should provide some protection here in the near and intermediate term. But at the end of the day, U.S. producers are higher cost producers. So, that $50 level seems to be at the point that we need to see for U.S. producers to, generate some profitability and continue to produce. Prices getting down to that $35 level or sub 40, clearly U.S. producers are not in a position to handle that. So it's definitely in the best interest that some deal is reached, and an enforceable one at that.
Absolutely. Tim, we will leave it there. Thank you so much for your time today, and we'll certainly be keeping a close eye on that meeting set to take place on November 30. Thank you.